Ki te whare paramata e tūnei, ki te mana whenua o tēnei rohe, taranaki whānui, ki te upoko o te ika, ki ngā tangata kua hui hui mai nei, tēnā koutou, tēnā koutou, tēnā koutou katoa. My name's Evie, I'm from the Reserve Bank, and I don't know anything about trucks. So I'm here today to talk to you a little bit about the domestic economy, where we're at and where we're heading. So this presentation is going to be based on the views of the MPC as at our latest monetary policy statement, which came out towards the end of May. At the end of the session, there will be time for questions, and I really encourage you to put some questions in because that's the most fun and interesting part. As you know, there's been a lot of material developments in the world economy over the last few days or even the last few weeks. I won't talk in too much detail about how those affect the outlook because the genuine truth is we don't really know. We haven't really decided yet. The Monetary Policy Committee will be meeting next week to start discussing the outlook for the next rates decision. So, usual disclaimer, I'm talking on behalf of the MPC, but I won't be reflecting the views of any individual member or my own views. So let's crack into it. Let's start with where the economy was at leading into the conflict that emerged in late February 2026. We'd had a couple of rough years. Growth was low, had been very volatile, unemployment was rising, and cost pressures were extremely high. Many businesses were struggling. However, we were starting to see at the start of 2026 some real signs of recovery in the economic outlook. Inflation was near the top of the band, but close to target, and the Monetary Policy Committee was expecting to have to gradually raise rates this year as the economy started to recover. However, the conflict has materially altered the outlook and the balance of risk for inflation and economic growth globally and in New Zealand. On the growth side, high petrol prices eat into people's wallets, reduce the amount they have left over to spend on everything else, and that causes a lot of risk to businesses. On the inflation side, obviously diesel, petrol, and oil-related product prices are rising, but as you guys are all very well aware, these inputs feed into just about everything that gets produced in this economy, and that has risk of causing generalised inflationary pressure. So based on the outlook for oil prices in May, CPI inflation was projected to peak at 4.3% in the September 2026 quarter. As you may know, oil prices, petrol and diesel prices have fallen considerably since that date. That's likely to take a little bit of the heat off of the top of that cycle. Inflation is projected to return to the midpoint of the target band by mid-next year. The economy is projected to recover gradually. And in May, the committee voted 3-3 to hold the OCR at 2.25%, but signalled that the OCR is likely to increase in coming meetings. Turning to the details of the conflict. The number of ships that have passed through the Strait of Hormuz has fallen dramatically. This represents a reduction in the global oil supply and a real loss to the world economy. If we were to update this chart to represent the last couple of days, you might have heard in the news that ships have started moving through the strait. However, the biggest days that we've seen in the last couple of days are around about 30 or 40 ships in one day. If you take a look at the scale of that chart, you can see that this still represents a very material reduction in oil supply that is expected to persist for some time, even after conflict resolves. This chart doesn't account for all of the change in global oil. It doesn't account for the small amounts that have been able to leave the Gulf via other routes. It doesn't account for the release of global strategic oil reserves, and it doesn't account for the increase in production from other regions given high prices. However, it's a pretty good summary of the real global economic loss that can't be pulled back. We have some better news on oil prices. So even at the time of the May monetary policy statement, oil prices were projected to decline through the course of this year. In fact, as of the data that I looked at yesterday, the price for Dubai oil is somewhere around about $65 to $70 a barrel today, so almost back to pre-conflict levels already. The futures prices, so the price that people expect in the future, are also much lower than assumed in this projection. And this is going to mean continued downward pressure on fuel prices in New Zealand and around the world. However, we have already experienced the shock. It's not the case that when petrol prices go back to normal, all of our cost pressures go back to normal. You guys probably know better than anybody that it takes a long time for these costs that have been built up and have been faced by businesses in New Zealand to disseminate through the economy. The outlook for global inflation is still elevated, and that means the outlook for the prices of all the consumer goods around the world and in New Zealand remains elevated. As a consequence, most central banks are expected to raise interest rates over the coming years, or at least decrease them by less than otherwise assumed, in order to keep a lid on that inflationary pressure. These numbers here are somewhat out of date, so I wouldn't advise that you look into them too closely, but I can tell you that as of a few days ago, markets were calling slightly better than even odds for an interest rate increase in July. As of this morning, they're calling for slightly less than even odds, so more likely that the Monetary Policy Committee will hold. As I've mentioned, the Monetary Policy Committee doesn't yet have a view on this because they haven't met. And finally, it's important to remember that oil prices are not the only prices in the economy. In New Zealand, we have been benefiting from a long time, for a few years, from strong dairy prices, strong meat prices, and good returns on a broad range of our agricultural exports. That has seen the terms of trade improve for the last couple of years. However, that is completely swamped by the volume and the price of the oil and petrol and diesel that's consumed in this country. So what does all that mean for the economic outlook? Essentially, our analysis is that growth is likely to be slower, but not as weak as it has been in 2024 and 2025. Our projection for growth over the next year is significantly impacted by higher oil prices, but we do expect stronger growth than we've seen in recent years and a continued gradual recovery, even in the context of potentially increasing interest rates. If we look at a longer scale and we think about the degree of spare capacity in the economy compared to after the global financial crisis, you can see that our assessment is that the current state of the economy is not as cyclically weak as it was during the GFC, but that the length of time it takes for the economy to recover is almost as long. So that's consistent with probably what we're all feeling, which is that things have been pretty bad for a while, and it's going to take a while for them to get better. That flows through to the labour market. Unemployment peaked at 5.4% in 2025, and we expect numbers around that level in the coming quarters. So again, this isn't a story of things getting terribly worse, but the conflict means that things probably take longer to get better. Relatedly, wage growth is expected to be weak. This, of course, represents a double-edged sword. We all want higher wages. Higher wages means higher spending, means more customers, means better business, but it also means rising costs for businesses. These low wages, although they do represent weak demand and challenges on the sales side, also represent opportunity for business growth. So the outlook for inflation is that it's going to be pretty high in the short term, but we do think, particularly in the context of recently declining oil prices, that that will be relatively short-lived. Real petrol and diesel prices have reached the highest level that we've seen for over 50, 60 years. As oil supply comes back, we expect this to gradually recover. New Zealand is also somewhat less exposed to those high oil prices than it was in previous oil cycles. This is another reason for us to believe that although oil price cycles have led to high inflation in the past, it may do so to a lesser extent this time around. The other thing that means that inflation is likely to be slightly less of an issue than it has been in previous oil price cycles is that while cost pressures for businesses have increased, they're finding it very difficult to pass these costs on. So we've spoken to businesses across a range of different supply networks, grocery, retail, wholesale trade. Everybody across every part of the supply chain is reporting that it's difficult to pass costs on. While that may seem like a bad thing, and it definitely hurts the profits of the individual business, it does reduce the risk that this becomes a very dangerous inflationary cycle where your costs continue to rise across the board. So what we're saying is that we think that this is primarily a fuel price pressure issue in the short term and is unlikely to spill over to persistent inflationary pressures in the medium term. Of course, it's our job to be watching, continuing to evolve our understanding and reassessing as we go to ensure that our understanding is correct and that inflation isn't getting out of hand. So our projection, as I mentioned, is for inflation to be back at 2% by the middle of next year. Now that might look a little bit like a Goldilocks forecast. If you look at that pink line, it's really bad for 4 quarters and then boom, back exactly where we wanted. But we do think that there's relatively strong reasons for us to believe this to be the case. The first is mechanical. Oil prices have already increased, that is already baked into the annual inflation figure, and they have already declined. So provided that they don't re-accelerate, provided there's not something that causes oil prices to increase further, there'll be a mechanical reduction in CPI inflation in exactly 4 quarters' time as that high price drops out of the annual calculation. The other reasons are more fundamental globally. China remains a very important trading partner for New Zealand, and China has been experiencing very low inflation, around about 0%. Some of our other major trading partners have experienced high inflation in recent quarters, but they are in the process of increasing interest rates, slowing their economies, and we're expecting to see inflation in many of our other trading partners fall as well. Non-tradables inflation, as you can see from the blue line in the top of that chart, is already near around about 3%, which is a level which in the past has been consistent with 2% inflation. So what are we going to be watching to know that we are heading towards this forecast of 2%? The first thing we'll be looking very closely at is core inflation. These are measures of inflation that try and strip out the really volatile bits so that we can see into what are the underlying inflationary pressures in New Zealand. As you can see, so far in this cycle, core inflation has remained within the target band. If core inflation were to rise considerably in the next couple of quarters, that would be a signal to the Reserve Bank that potentially inflationary pressures are more broad-based than we thought, and interest rates might have to go up faster. The other place that we'll be looking really closely is inflation expectations. So this is basically reports from businesses and professional forecasters about where they think inflation is heading. It's very normal for us to see inflation expectations at 1 and 2 years ahead increase when you have an inflationary shock. That's a pretty reasonable and rational assumption. We have some comfort from the fact that the 5-year and 10-year expectations have remained relatively close to our 2% target midpoint. This is another thing where if this were to change, that might cause the committee to reevaluate its outlook for interest rates going forward. So what is the outlook for interest rates going forward? As at the May Monetary Policy Statement, the Monetary Policy Committee was very clear that they thought interest rates were likely to increase in some of the coming meetings. The committee voted 3-3 for a hold versus a hike. So 3 of our members emphasised that we had seen an inflationary shock, we understand well the consequences of that inflationary shock, and also we were already at a point before the shock where inflationary pressures were a little elevated and we knew that interest rates were probably likely to need to rise over the course of the year. So they advocated strongly for a rate increase. However, we had 3 other members who noted that there's extreme uncertainty about the outlook for the domestic economy. We had heard that cost pressures were not passing through the supply chain in great detail. We had heard that there were significant demand challenges, and we wanted to wait to see whether core inflation, wage inflation, and those measures of underlying inflationary pressure in the economy were going to pick up before making a decision. The other key element of uncertainty, of course, is the oil prices themselves and the outlook for the conflict. And as you guys know, over the last few days, there have been significant developments in that space, which also warranted possibly some waiting. In the statement, we did look at alternative scenarios, the way that the world could look a little different. One key scenario was oil prices staying at about $120 a barrel for the near future. That would have seen inflation rise considerably above our previous expectation of 4.2% and would have required the OCR to increase possibly above 4%. However, a key element of the scenario is the degree to which those high fuel prices end up being passed down through supply chains. We ran a second scenario with the same oil prices, the same economic conditions, but we assumed that the extent of pass-through was less. In that scenario, you're able to achieve similar growth outcomes, similar employment outcomes with a lower interest rate, if those fundamental cost pressures are less broad-based. The last scenario we considered was one in which the heightened uncertainty really weighed on consumer confidence, business confidence, investment, and consumption demand. In that case, we did see a world in which even with very high oil prices, interest rates would not need to rise above their current level. To sum up, we are in the early stages of recovery from quite a significant shock. There remains a significant amount of uncertainty about how the economy is evolving. Growth is likely to be weaker this year as a consequence of the high oil prices. Inflation is likely to be higher. However, the extent to which those pressures of higher costs versus weaker demand flow through to the costs that you guys face every day is yet to be seen. We'll be watching closely the outlook for core inflation, wages, and inflation expectations to help us understand the appropriate path for interest rates going forward. That's all I have to show you guys today. I'm not quite sure how this question works.
You mentioned that the Reserve Bank speaks with different businesses and engages with different sectors. So with transport and logistics, for example, is there a way the Reserve Bank's getting feedback and communicating sort of formally? Is there a way we can get there?
Yes, so the way that we select the businesses is very much based on existing connections, the size of the business in the sector. We do speak to both freight firms and advocacy groups. I don't think that we've spoken to Transport New Zealand, so we'll add you to our list. But yes, we did speak specifically to freight firms, and we heard about some of the ways that costs were being passed through or not being passed through at various stages of the supply chain. We also spoke to a lot of large wholesalers in spaces like grocery to understand how the costs were affecting their business and the outlook for them.
Someone was asked on the slide that the Fed have indicated they'll communicate less to avoid sending market signals. Is that a plan for New Zealand?
Absolutely not. So, in fact, our governor has indicated that she is very interested in increasing the amount of communication that's coming out of the Reserve Bank. So already we've started presenting at each of our monetary policy decisions as opposed to only at the monetary policy statement. We've increased the frequency of speeches. We've started publishing not only the votes that occur, but who voted for what. And we've also started to encourage our external MPC members, so the people who contribute to the monetary policy decision but are not employed by the Reserve Bank, to go out and share their individual views more. So no, I don't think that a Fed-style communication approach is on the horizon in New Zealand.
Give it up for Evelyn.